Lloyds Banking Group confirmed on 1 July 2026 that Halifax, a brand operating since 1853, will be scrapped. 190 branches rebranded, millions of accounts absorbed into Lloyds over the next 18 months. The announcement is framed as a simplification win, a long overdue consolidation of two brands that had already been quietly unified at the operational level. The provisional answer to why this matters for investors is not the brand itself. It is where Halifax customers go when the app icon changes and the incentive to stay disappears. Lloyds is the UK's largest mortgage lender and its dominant retail deposit taker. The brand axe concentrates all of that customer relationship capital under one name at precisely the moment that concentrating deposit loyalty is most difficult. BoE rate cuts are beginning. As rates fall, the margin between what Lloyds earns on loans and what it must offer savers to prevent switching will narrow. Lloyds' net interest income, which surged as the BoE held rates at elevated levels, now faces the first structural headwind since the hiking cycle began. The question is not whether the brand axe saves costs. It does. The question is whether those savings arrive before the NII compression accelerates, and whether Lloyds can retain Halifax's 8 million customers through a transition that competitors are already preparing to exploit.
The conventional reading of brand consolidation is straightforward. Fewer brands, fewer marketing budgets, fewer branch operations to run independently. Lloyds has been converging Halifax, Lloyds, and Bank of Scotland at the back end since 2025, when it introduced shared branch access and unified staff uniforms. The rebranding is the final visible step in that process, and management describes it as seamless. Community bank campaigner Derek French told This Is Money that the move buries the distinctiveness of the Halifax offering. Which Money editor Jenny Ross warned that Halifax customers will almost certainly feel the loss. These are not just sentiment objections. They signal the conditions under which deposit attrition becomes a real financial variable. In a rising rate environment, customers tend to stay with their current bank because switching is a friction and rates are broadly similar. In a falling rate environment, challenger banks and higher rate deposit platforms have the strongest argument for switching they have had in years. The 178 locations where a Lloyds branch and a Halifax branch sit in close proximity become a particular pressure point. Customers in those areas already had a choice, and the new single brand offering gives them a clear moment to reconsider. What the surface reading misses is that brand loyalty and retail banking is not a soft metric. It is the friction that holds deposits in place during competitive repricing. Lloyds is removing that friction at the exact moment competitors will use it against them.
The BoE held its base rate at 3.75% at its June 2026 meeting, with CPI at 2.8%, a 13-month low. Goldman Sachs now expects the bank to cut to 3% by February 2027, having previously penciled in a trough of 2.75%. The rate path is lower and shallower than the market expected 6 months ago, but it is still a cut cycle, and Lloyds is the bank most directly exposed to it. Lloyds' structural hedge, the long-duration fixed-rate book that shields NII from short-term rate moves, was the source of its earnings resilience as rates rose. As rates fall, that hedge rolls off and must be rebuilt at lower yields. RBC Capital Markets noted that Lloyds is more disciplined in deposit pricing, which translates to lower volumes but better margins. Deutsche Bank rates NatWest buy, Lloyds hold. Berenberg's latest broker note carries the same split. The divergence is specific. NatWest is flagged as the largest beneficiary in the near term for structural hedge income as swap rates move higher, while Lloyds is seen as more margin-sensitive to deposit repricing. Both banks face the same macro force: BoE cuts, mortgage demand recovering, deposit competition intensifying, but NatWest's balance sheet positioning is judged to be more defensive on the NII line. That is the buried assumption in the Lloyds simplification trade. The cost savings from the Halifax axe are real, but the timing pits them against an accelerating structural headwind in the same quarter that the new CEO is due to unveil his next 5-year plan. Lloyds CEO Charlie Nunn is scheduled to present half-year results alongside a new strategic plan at the end of July 2026. That is the earliest verifiable checkpoint where the market will have access to 3 variables that the current surface read leaves unresolved. First, whether NII guidance for the second half has been revised down to reflect the deposit repricing environment. Second, whether Halifax migration costs have been provisioned.
Management has offered no formal cost estimate for transitioning 8 million accounts and rebranding 190 branches, and that number will matter for full-year earnings. Third, whether Nunn's new 5-year plan addresses the deposit retention risk directly or frames the Brand Acts purely as a cost story. The counter-evidence in the pool is not trivial. UK unemployment has risen to 5.2%, close to a 5-year high, and the BoE's own stress test scenario includes a recession in which Lloyds' mortgage book, the largest in the country, faces impairment pressure alongside margin compression. That combination is not the base case, but it is the scenario in which the brand consolidation savings evaporate and the deposit attrition risk compounds. For a holder sitting near a 52-week high, the question before the July results is precise. If NII guidance holds and migration costs are below £200 million, the simplification trade holds and the shares have room to run. If NII is guided lower or Nunn's plan includes a downgrade in mortgage volume assumptions, the Brand Acts becomes a signal of defensiveness rather than efficiency, and the valuation at current levels does not hold. That is the single variable to watch before acting, not the brand announcement itself, which is already priced in. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.